When I was just starting to learn about investing, I was very confused about the many things that I could possibly invest in. And whenever I was seeking advice from someone else about the topic, he or she would tell me to invest in whatever they liked to invest in. When I asked my landlord, he told me to buy an index fund. When I talked to my friend's dad, he told me to buy silver. When I asked my pastor at church, he told me to get into real estate. Everyone had a one way about doing it, and to them it was the only way that someone could possibly make money. As I learned more about investing, I came to realize that there is no one thing that I could invest in and would make me money all the time. Things are constantly moving in the investing world, and what worked 5 years ago might not work for the next a few years. Personally, I think that in order for us to be successful in our investing journey, we need to learn about as many assets as we can and learn when to buy or sell any of these assets. In this video, I'm going to go over some of the most popular asset classes and investment vehicles, and I'm going to state the pros and cons of each one of these. The first asset class is cash. For most of us, the story of having cash goes like this. You go to work, you earn money, you spend some of it on rent, food, and other day-to-day expenses, and if you are smart, you save some of that money every month. As time passes, your pile of cash grows. This cash represents your excess productivity and purchasing power. Cash comes in many colors and flavors. When I say that, I mean there are many currencies that you can use to store your purchasing power. I would argue that the first investment any of us need to learn how to make is picking the right currency that would allow us to store our purchasing power for as long as possible. There are many examples of good currencies and bad currencies. Some good currencies that have been a good store of value so far are the US dollar, the euro, the Japanese yen, and the Swiss franc. Some bad currencies that have been a lousy store of value are the Turkish lira, the Argentinian peso, the Russian ruble, and the Venezuelan bolivar. The best way to know if a currency is a good or lousy store of value is to compare it to other currencies. Please do not save your hard-earned money in a lousy currency. I hate to see anyone get impoverished and lose their purchasing power that way. Personally, my currency of choice is the US dollar. All currencies have their flaws and might lose some of their value due to inflation and central banks' money printing, which is the definition of currency debasement. That is why we need to try to use our saved cash to buy other assets that will go up in value over time. Next, I would like to discuss savings accounts and CDs, or certificates of deposit. These savings vehicles should be the first thing to look at for anybody with a good size cash position. These products are offered typically by banks and most often come with a form of insurance, so you are getting a risk-free return. Check out the banks that you have access to in your country and see how much they are offering on savings accounts and CDs. You might be able to get a good deal online. You just need to make sure that you are using a legitimate bank that has a good reputation and offers insurance on their savings products. Personally, I prefer big national banks over small community banks. However, it's worth mentioning that the interest that you will earn on these bank products will only help you keep up with inflation at best. The next asset on this list is bonds. When you buy a bond, you are loaning your money to a corporation or the government for a certain period of time. In return, the issuer of the bond agrees to pay you a fixed amount of interest every year until the bond reaches maturity. At maturity, the borrower is supposed to return your original loan money. Not all bonds are the same. Some bonds are considered safer than others. For example, government bonds are considered safer than corporate bonds. The safety of a bond depends on the ability of the borrower to repay your money back plus interest. There are two main reasons for investors to buy bonds. One, bonds pay fixed amount of interest. That is why they call them fixed interest instruments. Two, bonds are sensitive to interest rates set by the central bank. How this works is that after you buy a bond, if the central bank decides to raise interest rates, then the price of your bond goes down. And if the central bank decides to lower interest rates, then the price of your bond goes up. So, a lot of investors buy bonds to speculate on interest rates. When investors think that the economy will go into a recession soon, and as a result, the central bank will lower interest rates to stimulate the economy, they buy bonds. If they are right on their assumption, then their bonds go up, and they make money that way. That's why you hear financial advisors saying you need bonds in your investment portfolio because they go up when stocks go down. It's because they assume that interest rates will go down during a recession, and as a result, bonds will go up. The next popular asset is stocks. When you buy a stock, you are becoming an owner of a company. Stocks are risky because a lot of things can go wrong with any company. Companies can be mismanaged, lose money, and even go bankrupt. The best way to lower these risks and increase your probability of success when investing in stocks is to buy a group of them. That way, you are not putting all your eggs in the same basket. Personally, I prefer investing in index funds like the Vanguard Total Stock Market ETF VTI, for example, because it's diversified and tend to do well in the long run. In my opinion, the key to success when investing in stocks is to buy them at a fair valuation and hold them for a long time. Also, it's a good idea to dollar cost average when buying stocks, which means buying into stocks a little bit at a time over a long period. The next asset on this list is gold. Gold is a store of value over a long period of time. Gold tends to go up in price when there is inflation, So it's an inflation hedge. It's also an insurance against systemic failure and money printing. The key to success when investing in gold is to buy it when its price is close to its mining cost and hold it for a long time. The final asset on this list is real estate. There are two ways to invest in real estate. The first way is to buy a property. Personally, I think this way of investing in real estate can be profitable if you buy a property at a reasonable price and it is cash flow positive, which means that the rent that you receive from the property covers all the expenses, plus you are left with a decent profit. Ideally, you want the profit that you get from the monthly rent to be close to 1% of the value of the property. For example, if you buy a property for $100,000, then ideally you want to be getting $1,000 per month from the rent, which is 1% of the value of the property. The second way to invest in real estate is to buy a REIT, which stands for Real Estate Investment Trust. An example of REITs would be the Vanguard REIT, VNQ. REITs usually pay high dividend, and if you can buy a good REIT like VNQ at fair valuation and hold it for a long time, then it could be a good investment. That's all for this video. If you found it informative, please give us a like and comment down below. I really would like to hear from you guys. Also, please consider subscribing to our channel. We have new videos every day about investing and personal finance. Thanks for watching.